In this video, we'll elevate your risk management by mastering portfolio Greeks and net exposure. You have learned about delta, gamma, theta, and vega for individual trades in our previous episodes. However, looking at positions in isolation leaves you blind to your total systemic risk. Portfolio Greeks aggregate these metrics, providing a single dashboard view of how your entire account will react to market changes, time decay, and volatility shifts. A common mistake is simply adding raw deltas together. 100 delta in a penny stock is not the same financial risk as 100 delta in a high-priced tech giant. To aggregate accurately, we use beta weighting, usually against the SPY. This formula converts the risk of every position into an equivalent number of S&P 500 shares, creating a standardized unit of measure for your exposure. Once beta weighted, we can mathematically sum the values to find our net exposure. Net portfolio delta shows your total directional bias, while net theta reveals your total daily theoretical decay income. In this example, notice how a short call in a high beta stock can neutralize the directional risk of a long position in a different sector. Interpreting these numbers is key to survival. If your net portfolio delta is positive 50, your entire portfolio behaves mathematically like owning 50 shares of the SPY. If your net vega is negative, you profit when implied volatility collapses. This holistic view prevents silent risk accumulation, where multiple diverse trades actually bet on the exact same market condition. The goal isn't always to be neutral, but to be intentional with your exposure. If your net delta gets too bullish during a market peak, you don't need to close winning bullish trades. Instead, you can open a new bearish trade or hedge to bring the net delta back within your target range. This is dynamic portfolio hedging using the Greeks as your compass. Thanks for watching, and stay risk-aware.